Welcome, everyone, to the deep dive. Today, we're going deep into the Indian residential real estate market, early 2025, sort of where we are right now. And we're going to be basing this primarily on the GRI Residential India report.
Yeah.
This report really captures some really interesting discussions that were had by a bunch of leading experts at the GRI Club India Conference.
Yeah, it's one of those things where, we see the headlines, right? And we're like, oh, wow, things are moving. But this is like the behind the scenes, We're getting the perspectives of the people who are really driving the action in this market.
Exactly. And, for you listening, our mission here is to kind of extract the most important insights. Where's this market today? Where's it heading tomorrow?
Right.
We want to kind of give you that rapid download. And we're going to be looking at a few key things. First, the luxury demand. It's huge. Everyone's talking about it. Then the diversification opportunities. Where are people looking beyond the usual suspects?
Right.
And, of course, the financials, the money behind it all. How's this all working? What are the trends?
Yeah. And, one of the things that jumps out immediately is just this remarkable growth in India's luxury home sector. It's really unprecedented.
And the report doesn't mince words. They call it an unprecedented expansion. And when you look at the projected figures for 2024, it's hard to argue. I mean, we're talking about potential total residential sales just in the top 7 cities exceeding INR 5.1 trillion. That's over 300,000 units sold. And this could be the third year in a row, the third consecutive year of these record-breaking sales. I mean, what's driving this appetite, this real hunger at the high end of the market?
Well, the report points to a few things. First, you've got these high net worth individuals, people with serious assets. Then the NRIs, non-resident Indian investors. And, they're putting their money where their mouth is. And then, of course, the domestic buyers, people who are, looking at their portfolios and going, all right, how do we reallocate this?
Yeah.
So it's not just one group. It's this confluence of factors that's driving this luxury boom.
And the report talks about this increase in high-value transactions. So it's not just more sales, it's bigger sales. Higher ticket items are being moved at a much faster clip.
Absolutely. And, we're seeing cities like Mumbai, Gurgaon, Bangalore, they're leading the pack. Unprecedented absorption rates, properties are being snapped up,
It's like hotcakes. I mean, I can't even imagine what that's like. But, it's also interesting because we think of high net worth individuals, but it's not just individuals, right? I mean, family offices, institutional investors, they're getting in on the action too.
Absolutely. They see this as a stable investment. They see the value, the long-term potential, and they're not afraid to deploy capital. They're looking at structured real estate funds, alternative investment vehicles, really anything to get a piece of the pie.
Yeah, and it's interesting, the role that NRIs are playing.
Right.
They're actively acquiring premium properties in major Indian metros. And they're doing this as part of their long-term wealth preservation strategies. I mean, it's not just like a quick flip. This is like a long game, right?
Yeah, absolutely. And, the report connects this to global trends that we're seeing, similar things happening in Dubai and the UK. And, these are savvy investors. They're not going to park their money somewhere unless they see real potential.
And, it begs the question, what is it about luxury real estate right now that's so attractive?
Well, I mean, the world's a little crazy, right? So first of all, you've got this post-pandemic realization. Real estate, it's tangible. It's a hedge against inflation. You can touch it.
Yeah. It's not going anywhere.
It's not going anywhere. Then on top of that, you've got this massive infrastructure development happening.
Right.
New metro lines, expressways, commercial hubs. It's making these urban centers even more desirable.
And more attractive, yeah.
And then you can't ignore the stock market rally. It's created a lot of wealth. And some of that wealth naturally is flowing into real estate.
Yeah, people got to park it somewhere.
Exactly.
And, okay, so Mumbai, still the king, right? Still the big dog. But it's not the only game in town anymore. I mean, Gurgaon, Hyderabad, Bangalore, the report calls them formidable contenders.
Yes.
So what's driving their rise in this luxury sector?
Well, I mean, it's a reflection of the broader economic landscape, right? I mean, these cities they're booming. You've got strong economic growth, tons of investment in infrastructure, and consumer preferences are changing. People are looking for different things.
There's different lifestyles.
Exactly. And each of these cities has its own flavor. Gurgaon, for example, has become a real magnet for luxury developments. I mean, they're seeing record-breaking transactions. You've got ultra-high net worth individuals flocking there. It's become a hub.
It's like the place to be.
It is. And then you've got Bangalore. With its thriving IT and financial industries, it's attracting a whole different breed of luxury buyer. Think C-suite executives, entrepreneurs, international investors. They're looking for those high-rise penthouses, those exclusive gated communities. It's a very specific, kind of a global tech-savvy kind of luxury.
Yeah, yeah. And, it's interesting because the diversification story doesn't stop there.
Yeah.
It goes beyond these major metros.
Right.
I mean, Tier 2 and Tier 3 cities, places like Surat, Indore, Lucknow, they're becoming increasingly attractive to both developers and investors.
Absolutely. I mean, rising local affluence, infrastructure improvements, increasing land values. It's a recipe for opportunity.
And I noticed the report pointed out a key difference in the investment strategy for these emerging markets. It's not so much about, building these massive high-density apartment buildings, right?
Right.
It's more about plotted development. So why this preference for land over towers?
Well, when you look at it from the developer's perspective, plotted developments in these Tier 2 and 3 cities, it's a faster return. The capital turnover is quicker. There's less risk compared to these huge apartment projects. And frankly, the absorption rates are better. They're selling.
Okay, yeah.
And, from the buyer's perspective, think about it. They're often looking for larger plots. They want that space. They want that independence, gated communities, high-end amenities, but without, living on top of each other.
Yeah, they want the lifestyle, but they also want their space.
Exactly.
But I'm sure there are challenges for developers who are, trying to make this move. The report talks about, the staying power of demand.
Yeah.
And also competition from these local developers who already have a foothold.
Yeah. I mean, you can't just waltz into these markets and expect to dominate, right? You have to understand the local dynamics. You have to assess the long-term strength of demand. And, these local developers, they've got the relationships. They understand the nuances of the market.
Yeah, they've been there, done that.
Exactly. And, the report makes a really key point. They say that the growth of luxury housing in these smaller cities, it's highly dependent on continued infrastructure development, highways, metro lines, commercial centers. These things are essential if you want to see long-term property value appreciation.
Right. And, it's interesting to see how developers are adapting their strategies. The report talks about the adoption of these flexible pricing models, launching projects based on actual demand, not just, throwing something up and hoping it sticks.
Right. It's a much more cautious and data-driven approach. They're being smart about it.
Yeah.
But the report also flags something that, should give us all pause. They talk about this contraction of traditional lending sources. And that's a big deal. I mean, you've got the NBFCs, the non-banking financial companies, they're pulling back. And the banks, they're tightening their lending criteria. So it's becoming more difficult for developers to get the financing they need.
Which brings us to, the money, the financial strategies that are being used for these high-end developments.
Yeah.
And, it's interesting because on the one hand, you have this strong demand, but on the other hand, you have these rising land costs. The report says they've doubled in prime urban areas.
Yeah.
And this changing availability of capital, it's like this push and pull, right?
It is. And, when land and construction costs go up, it squeezes profit margins. But developers also have to keep prices attractive to buyers, especially in the luxury segment.
Yeah, you can't price yourself out of the market.
Exactly. So the report suggests that developers with, those strong brands, a track record of success, they have an advantage. They're the ones who can access structured debt, hybrid financing, more sophisticated, tailored loan arrangements.
And it's not just traditional financing anymore. I mean, we're seeing new avenues opening up, things like REITs, real estate investment trusts, and HNWI syndicates, right? These groups of high net worth individuals who are pooling their resources to invest.
Yeah. It's interesting. Family offices, private wealth managers, they're seeing real estate, especially luxury real estate, as a very attractive asset class. And the report even mentions that, multi-million-dollar deals among private investors, they're becoming more and more common.
Yeah, it's like this whole new layer of the market is opening up.
It is. And, if we zoom out a bit, we're also seeing a lot of strategic consolidation in the real estate sector, particularly at the high end. I mean, since the pandemic, there have been a lot of mergers, acquisitions, partnerships, and it's making the market more concentrated. The big players are getting bigger.
Yeah, the big fish are eating the little fish.
Exactly. And the smaller players, they're often going the joint venture route.
To kind of stay in the game.
Stay in the game, exactly. Yeah. And the sources of funding, they're also evolving. The report points to this growing reliance on structured financing solutions, equity-based funding, institutional partnerships, private equity firms, alternative investment funds, AIFs, joint ventures with foreign institutional investors, and the data on private equity funding by asset class, it really tells a story.
Yeah, it's almost like a shift in mindset.
It is. I mean, if you look at the numbers year over year, funding for office properties, it's plummeted from 73% in the first half of fiscal year 2024 to just 17% in the same period of fiscal year 2025.
Wow.
Meanwhile, funding for residential more than doubled from 8% to 17%.
Interesting.
And the real standout, industry and logistics, it's gone from 16% to a whopping 66%. So there's a clear movement, a reallocation of capital,
right,
towards these sectors.
Mm-hmm. Okay, so beyond the luxury hubs, where else are investors and developers looking? The report talks about, diversifying portfolios, tier 2 and 3 cities, but also these alternative residential property types.
Absolutely. The growth story, it's not just geographical, it's also about how people want to live. Co-living spaces, senior housing, branded residences, these are all gaining traction.
Let's talk about those tier 2 and 3 cities for a second. The report gives examples like Jaipur, Coimbatore, Visakhapatnam, Bhubaneswar, Surat.
Right.
And they attribute, their attractiveness to this economic growth, infrastructure development, rising disposable incomes. So it sounds like, these are the new frontiers in a way.
They are. I mean, these cities are undergoing this incredible transformation. They're becoming more urbanized. New IT hubs, manufacturing centers are popping up. Yeah. And the government is investing in infrastructure. So it's creating this very fertile ground for real estate demand. And the connectivity, it's improving. Road networks, airports, metro systems. It's making these locations more appealing to live in and to invest in.
And, I was looking at the new unit supply table in the report. And it's interesting because you see these different growth patterns like Gandhinagar, Bhubaneswar. They had these huge percentage increases in new housing supply between fiscal year 2020 and 2024.
Right.
But then you have places like Mohali and Vadodara that actually saw a decline. So it's not uniform. It's very specific to each city.
Yeah, absolutely. And as we talked about earlier, the preferred type of development in these markets, it's plotted land. It's faster, it's less risky, and it aligns with that desire for, independent housing that we see in these cities. And of course, land in the major metros is getting so expensive that it's pushing developers to look elsewhere. And even though land prices in these tier 2 and 3 cities are also rising, they're still relatively affordable.
Yeah. And the report had this table that really caught my eye and talked about this 94% surge in residential property prices in tier 2 cities. I mean, Agra, Goa, Ludhiana, they're seeing these incredible price increases.
They are. But, the report also cautions that it's not just about building houses. It's about creating what they call livable communities, places with good schools, hospitals, retail centers. That's what creates long-term market stability. And developers, they have to be smart about how they enter these markets. They need to do their homework, analyze the data, phase their investments, don't just jump in headfirst.
Right. Be strategic. Okay, so let's talk about these alternative residential property types. Co-living, that's the one everyone's buzzing about, right?
Yeah, and it's interesting because it's almost like a comeback story. There was this initial wave of interest pre-pandemic between 2017 and 2019.
Yeah.
But then, COVID hit, things kind of slowed down. But now the underlying drivers, they haven't gone away. Young professionals moving to cities for work, affordability challenges. So co-living it's back. And if you look at the numbers, the co-living in India, a snapshot table shows this huge increase in the number of beds available from, over 200,000 up to 2019 to a projected 450,000 plus by 2024. So there's definitely growth there.
It sounds like, it's still early days. The report talks about, investors being cautious. Rental yields are lower compared to traditional housing. Managing these shared spaces, it's complex. And the market's fragmented. It's not like there's one big player dominating.
Right, right. And the operational challenges can be significant, managing tenant relationships, ensuring smooth operations. These are all things that can impact profitability.
So it's a bit of a Wild West still.
It is. It is.
Okay, senior housing. This is an interesting one. I mean, India has this tradition of multi-generational living, right? So it seems like, the concept of senior housing, it's a bit of a shift.
Yeah, it is. But, things are changing. Urbanization is happening at such a rapid pace.
Yeah.
And, family structures are evolving. So the need for dedicated senior living options, it's growing.
Yeah.
And, the report talks about these operational challenges, the long-term commitment that's required to manage services in this sector. And we're seeing this trend towards incorporating senior living facilities within a larger mixed-use developments. It's almost like creating these mini communities within a community.
Right, right.
And, the market penetration of organized senior living in India chart, it shows that the current penetration rate is still quite low, just 1.3% in 2024. But the potential demand is huge, so there's a lot of room for growth, but it's a very specific market. It requires a lot of specialized expertise.
Yeah, you got to know what you're doing.
You do.
Okay, branded residences. This is the super luxury.
Yeah, it's the top tier. These residences are associated with global hospitality brands, and they're really targeting HNWIs, those high net worth individuals who want the best of the best. Luxury living, hotel-like amenities, concierge services. It's all about that premium experience.
Yeah, it's a lifestyle.
It is. And the report notes that this model has been very successful in commanding premium prices, especially in major metropolitan areas where you have a lot of international and NRI buyers. And what's interesting is that we're seeing this expansion into the upper mid-market category. So it's not just the ultra-rich anymore. And the bar chart on, operational and planned branded residence units across India, it shows that they're concentrated in the major metro cities, places where that demand is the strongest.
Okay. So despite the potential of these alternative property types, the report kind of strikes a note of caution. They talk about developers and investors being a little bit wary about the scalability and the long-term financial viability of these different formats. Because of this ongoing need for service management and the difficulty of exiting these investments, it's not as simple as just selling an apartment.
Exactly. It's a different beast. And, it all comes back to the issue of funding.
Yeah.
The report reiterates that these rising land costs, the regulatory hurdles, investor sentiment, it's making it much more challenging to secure financing. And as we've discussed, those niche segments, senior living, co-living, they face even greater hurdles.
Yeah, it's riskier.
It is. And, investors, they're looking for scale. They're looking for high-yield projects. And the NBFCs are scaling back. The domestic banks are becoming more selective. So it's forcing developers to be more creative, to look at those structured financial solutions, private equity, debt financing, institutional partnerships.
And it seems like institutional investors and family offices, they're willing to back those high-value luxury projects,
right?
The branded residences.
Right.
But they're still hesitant about the alternative residential segments.
Yeah. There's still a lot of uncertainty there. And, these alternative properties, they require a lot of long-term operational expertise. You got to manage tenants, you got to provide services.
Yeah.
And that adds another layer of complexity for investors.
Right. So it's interesting because it seems like the successful developers, they're adopting these hybrid financial models, combining traditional sales with, strategic investments in these alternative housing formats. It's like they're hedging their bets.
Exactly. They're trying to balance those different revenue streams.
So let's dig a little deeper into this whole idea of leveraging family office and HNWI capital. The report talks about Indian family offices becoming a major force in residential real estate investment.
Yeah. I mean, their capital allocations are increasing significantly, and the numbers are pretty staggering. The number of family offices has exploded from just 45 in 2018 to 300, according to PwC. That's huge.
So what's driving this growth?
Well, a lot of these families, they built their wealth in traditional industries, and now that wealth is being transitioned into more structured investment vehicles. And, the younger generation, they're more comfortable with this. They prefer a more institutionalized approach to asset management. So it's really changing the landscape of real estate investment.
And we're seeing this shift away from direct ownership, more towards, investments in funds, co-investment opportunities, AIFs, REITs. It's about diversification, passive income, liquidity.
Right. It's about, managing risk and optimizing returns. And even debt-based real estate investments are looking more attractive now, especially with interest rates being higher.
And, it's not just about investing in India anymore. The report talks about this trend of allocating capital to offshore real estate markets. London, Dubai, Singapore.
Yeah. It's about hedging, spreading your risk geographically. And a lot of these private real estate funds and co-investment platforms, they're making it easier for Indian investors to access these international markets.
So while direct ownership of, strategic land, trophy assets, it's still a thing, the overall trend is definitely towards more active financial participation by family offices.
Absolutely. And, the report highlights some of the challenges in deploying this family office capital. Things like trust barriers, regulatory hurdles. A lot of these families are very focused on preserving their legacy, so they're not going to jump into anything without doing their due diligence. They're very cautious.
Yeah, it's not just about the quick buck.
No, it's about long-term value.
Long-term value, right. And they're looking for fund managers with strong governance, a proven track record, transparency. It's about trust and security.
Absolutely. And navigating the regulatory landscape, especially for these structured investment vehicles, it can be quite complex, compliance, tax, governance. It's a lot to juggle.
Yeah, it's a whole different ballgame. And what's interesting is that we're seeing more international family offices entering the Indian market. They're attracted by these premium residential projects, the high-yield debt funds. So it's becoming more globalized in a way.
It is. And, the future growth of family office participation, it's really going to depend on how these investment frameworks evolve to meet their specific needs.
Okay, so let's get down to brass tacks here. Costs, margins, ROI. The bottom line. The report says that profitability in residential real estate is facing some serious pressure.
Yeah, it is. Rising construction costs, regulatory expenses, marketing expenditures. It's a tough environment.
Yeah.
And, that traditional EBITDA margin target, 25% to 35%, it's becoming harder to hit consistently. In high growth markets, you might be able to achieve those higher margins. But if the market gets volatile, you can easily see margins drop to 20% or even lower.
Yeah, so it's a risk.
It is. And, these joint development agreements with landowners, they're becoming more common. But they also put pressure on margins because the landowner typically takes a significant cut of the revenue.
Okay.
And the thing is, costs are unpredictable. They can fluctuate across different phases of a project. So they're having to get creative, flexible pricing models, optimized timelines, phased launches. They're trying to stay ahead of the curve. And a strong brand, it really helps. It gives you that pricing power.
Right. People are willing to pay a premium for a known quantity.
Absolutely. But, newer developers, those entering new markets, they have to spend more on acquisition and marketing. They have to build that brand recognition.
Okay, so let's talk about mitigating these rising development costs. The report talks about raw material prices, skilled labor shortages, regulatory compliance. These are big ticket items, right? They are. I mean, the prices of, basic materials, cement, steel, aluminum, they've gone through the roof. And there's just not enough skilled labor to go around, so wages are higher. And developers are having to come up with, creative ways to retain their workers.
Yeah, you got to keep them happy.
You do. And then there's the regulatory burden. I mean, compliance, approvals, delays. It's a huge financial drain. Sometimes it's even more expensive than the actual construction.
Wow.
Changes in environmental regulations, municipal development charges, premium FSI pricing, it all adds up. And these delays, they mean higher financing expenses.
Yeah.
Your capital is locked up for longer. So the industry it's trying to adapt. They're optimizing their supply chains. They're adopting these advanced construction technologies, precast construction, AI-driven tools. They're building strong in-house teams to manage projects more efficiently. So it's about working smarter, not harder.
Exactly. And the price cost change of key construction components section, it really highlights the specific cost pressures on materials and labor.
Yeah.
And we can't forget about marketing, especially in those premium markets where you're trying to sell those high-end properties.
Yeah, marketing costs can eat into your margins pretty quickly.
They can, and they vary a lot from, 5% to 17% of revenue. And established developers, they have an advantage. They've got those strong brands. They can rely on referrals, in-house teams.
Yeah.
But newer entrants, they have to spend more. building their brand, digital campaigns, broker networks.
Yeah.
And what's interesting is that even though digital marketing is becoming more and more important, the report emphasizes the need for personalized sales experiences, especially for those luxury buyers.
Yeah.
Site visits, experience centers, that high-touch, relationship-driven approach, it still matters, but it also costs more.
Yeah, it's all about that personal touch.
It is. And the construction cost for various asset classes table, it shows the cost differences for different types of apartments in different cities: Bangalore, Chennai, Delhi, Hyderabad, Mumbai, Pune. It really highlights how location and the type of construction can impact those overall expenses.
So to kind of wrap this up, we've seen this robust luxury market driven by, a mix of investors, individual, institutional. We've seen this move towards diversification, geographically, but also into these alternative property types.
Right.
But we've also seen these challenges in securing capital and these increasing pressures on profitability. It's a complex and dynamic market.
It is. And, this deep dive, it's really given us a great overview of the key forces shaping the Indian residential market. And it's all based on, the insights of those leading experts at the GRI Club India Conference.
And, on that note, here's a final thought for you, our listener. Given everything we've discussed, this strength in the luxury market, the cautious steps into new markets, the financial complexities, what do you think the next big surprise in the Indian residential market will be? And how can you position yourself to navigate that? Just something to think about as you continue to explore this fascinating sector. Thanks for joining us on this deep dive.
Thanks for having me.